Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Agron. Hey, Doug.
Good morning, Kirk. Busy weekend for me. We Football's back. Went to the Vikings preseason game. Then I turned around, took my son to annual planning for scouts for the year. We were winding down to one more week until the kids are back in school. I can't believe the summer's coming to an end. I know they can't believe summer's coming to an end. How are things for you back in Massachusetts?
We're still normal. I know the rest of the country's gone crazy and they start school in the summer, but our kids still start after Labor Day. So thankfully, although
Yeah,
it's
they're
like,
starting us earlier this year. It's a new program. Like they're starting them earlier. They're condensing these classes. They're going to get out in May. I don't see the logic for it, but here we go. Oh, but this is going to be interesting. So my daughter and I went to she's on the soccer team, so they had their annual, their kickoff meeting yesterday. All the potential players had to show up for a pre-tryouts, which started this morning. And they brought it up again. That's something that they're changing this year: zero tolerance on cell phones in school.
good for
So
them.
it's not just talking on a phone. If they literally see it in their backpack in a pocket, and they have been told from the superintendent to the principal, if they see a phone under any circumstance, it's out of the locker, it will be confiscated. No exceptions. The parent has to come and get it. They will not give it back to the student. So this is going to be a hardcore. What I find is interesting, and I'm probably going to be controversial to people who are listening to this, because we've come to a world where we feel like it is a necessity. We can't live without it. We know that it's not true, right? We only allow that necessity to be as much as we want. We had pay phones. We could go to the office. People are like, well, what do we do if we need to call someone? Go to the office. Use the phone. Actually, it's nice. Back in the day, we had to have a quarter. If we didn't have a quarter, we couldn't call anybody. Now they'll actually just let you use the phone in the office. But man, the questions, the look of the students, the look of the parents. What I find interesting is the parents looked more scared and concerned about this change than the kids do. I think the kids are kind of like, okay, it's annoying, but some of the kids, from what I can tell, are like happy it's changing, because they're not going to see like half the kids just zoning out on their phone in the class. They're going to be forced to pay attention. The parents are the ones freaking out. The ones that grew up without cell phones are the ones that are scared, are the most scared to lose them.
Could
I
you
just
imagine, Doug, if you didn't have a phone and you had to like go to the wall and pick up the phone off of a wall and use that one? Imagine if that ever existed, you could just like
I,
maybe even pay for a phone on the wall. Imagine that. Like you'd have to put a quarter in to use it. Like that would be weird.
I
Uh,
I don't understand the concept at all. I was in this place called California where they did have these weird metal boxes that looked like what you were describing. They're still there with like a
I
plastic thing that goes up to your face.
I have to say I was in we went to last year. We went to a state park. It was like it's called It's called Pawtuckaway, I think is what it's called. Anyway, it's this cool state park with this great big lake, and there's like lots of little islands, and it's like the coolest thing. And it's just like state park. And as you're pulling in, on the right, there's a payphone. It's nowhere near anything. It's like in the woods. There's like this
Random.
payphone just sitting there. I'm like, what the hell? Like that was the weirdest thing. It's still there. It must be like the last payphone in the United States. But um, I agree. I think my oldest, when he was in elementary school, they had these things called, I think, yonder bags is what they call them, and they lock them. And what happens is I can't remember if they give them to the teachers or if the teachers give them and they have to keep it in the yonder bag. But the thing is I think when they go into school they have to lock it, and then when they leave school they can unlock it.
Mm-hmm.
So you could still have it, but it's locked, so you can't use it.
Nice.
I don't actually have an issue with the kids having it in their bags, because
Yeah.
I think my youngest right now, they can't take it out. The rule is they can't see it, but
Mm-hmm.
you can keep it in your bag, because if it's an emergency, it'd be nice to have.
Yep.
But the other thing is, what about an iWatch? Like that's basically a phone on your wrist. So what do you do about that? You can't have a watch. Like so,
100%.
yeah,
Yeah, and I'd say at least 50% of the kids now have Apple Watches. So
Yeah.
So that's definitely a reality. And I like the idea of it being in the back. And I think they're the same arguments. Like, it's supposed to be in your locker. If it's in your backpack, fine. If we never see it, no big deal. But you better not have it in an outside pocket. Like, it's got to be absolutely invisible. If it's seen, it's gone. I think it's a great thing because I've been in these areas. I've seen it. I've seen it in professional environments. I walk into a store and the rep in the store is just zoned out on their phone. Should have nothing to do in the space of a classroom. Should have nothing to do with the space of a work environment during the time in which you are supposed to be engaged. And I think we have created an environment where it not only promotes distraction, it promotes cheating. I mean, it's very easy to just pull things up, especially with AI, which we've talked about, has its pros, has its cons. But man, it is the reaction. That's going to be very interesting. I'm sure that I'm going to have some great stories as we continue our conversation over the next year.
Yeah, I find it really interesting. They talk about we talked about this article that was out a few weeks ago where it said AI is making people dumber.
Yeah.
It was like an MIT study, although that's its headline, because it's not really making people dumber, but it's making people not think.
It's intellectually lazier, right? Because
Right.
we don't have to critically process.
Right. But the same holds true for just cell phones in general. Like it makes people lazier, it makes people dumber. Like the kids, they're sitting there on their screen the whole day. They're just walking around like this. They don't even know what's going on. And
well, they can't. I mean, and the way they condense and contract the way they do things in quick type, TLDR, too long, didn't read. Like, it's broken English. I mean, and that starts to come out in the way they talk to you too.
Yeah, it's just the dumbing of people. Like it's just all of it. I think is probably not good, but you have to think about. I'm old school. Like, takes a lot to like move me forward because it's not that I'm Gen X just like you, Doug, but it's not that I can't move forward. It's just I always think about like what are the implications. So like, great, we allow kids to have cell phones and now they can't think for themselves, or they're not independent because we drive them around everywhere and you can't just let them bike to the town center because the cops will pick them up and yell at you as being a bad parent because you're letting your kids have independence. Like that kind of stuff. I really struggle with it. It's like, if you're going to make progress, it should be slow and should be deliberate. Like, you put your stuff on Facebook, it's up there forever. Like you put, a picture of you doing like a keg stand in college. That's going to be there till you're like 100 years old because your employer's going to be like, well, you're doing a keg stand in college. I'm not hiring you. Like,
and they watch that for sure.
Yeah. I mean, like as a kid, like I did plenty of stupid stuff and I hadn't, in general, I always thought I was like thoughtful enough to not do too stupid. Like, oh yeah, that's going to be bad news. But at the same time, that was through experience. How do you get good experience? Through a lot of bad experience. I made a lot of mistakes, and fortunately, none of them made it on the internet. Right? Like the things you do, you're like, I'm never going to tell anybody I did that. But at the same time, like it's not captured in high def on somebody's phone.
We're all living in reality TV now. Like,
right. And now the kids, like, they don't take risk. Like, I see my kids and like, they're nice and they're well-behaved, but like, I don't remember any kids that were well-behaved when I was a kid. Like, we're all a little bit on the borderline, like, doing stupid stuff. Like even in like the, I don't know, we used to call them like geeky kids, the smart kids. Like even they would do like
it's okay. Nerds is cool now. You can call them nerds.
I know. I said, it's funny. I said this to my father-in-law because I went to Micro Center, which is like a really good computer store.
From my hometown, Columbus, Ohio. I remember the first store when it opened.
Was that where it started? Oh,
it's Upper Arlington, Ohio is where Micro Center started. Yep.
All right. Well, they got one near MIT, and obviously MIT is a really, really smart school. And it's employed by a bunch of really, really smart, like geeky students. And so I love going over there because they're so damn smart. They know everything about computers. So I could go in and talk to somebody and they're going to know way more than I know. So I love going there because I have questions, they have answers. And I love the store. It's a great store. And so I said something to my father-in-law. I'm like, oh yeah, I just got a Micro Center. I love that store. There's a bunch of geeks selling you computers. And he like took it as offensive. I'm like, and I caught it. luckily. And I was like, no, I mean that in a positive way. Like, geeks is a cool word now. Like, we're growing up, it was like, he's a
Geek
geek.
Squad.
Nerds.
Geek Squad. I mean,
no, now it's like cool because those are the richest people on the planet.
right.
But the point being is, it's anyway, we get off the track. So, all right, I want to get into some real stuff here.
Sure.
So,
did you finish your thought though?
I feel like probably not, but I forget where I was. But doesn't matter.
You were at Micro Center. You said geeks, and your dad got offended.
I got my vision on vacation, Doug. I got 5
that was
days.
You know what? You just finished with your. Here's how you summarize it. That was your rebel moment with your father. It was really. I mean, it was the worst thing you ever did. Is you offended him over geeks. So moving on.
Yeah, father-in-law. Yeah, my father would not have been offended. My father-in-law, he's a little more sensitive to that, but that's okay. So, all right. So let's talk about a few things. We got some updated news. I'm going to talk about 2 things. Talk about the tariffs, which we didn't talk about last week. So the Trump tariffs have been enacted again, and not with the same fanfare that there were in April, which was rough, and seemingly people just don't care now. But fairly, most of them have dropped. So the European Union went from 30 to 15. Japan, South Korea dropped to 15. Taiwan, Vietnam is 20. United Kingdom's 10. Brazil 10. Israel dropped a little bit, but they were low to begin with. Turkey actually has gone up from 10 to 15. Brazil went. I'm sorry. No, okay. And the other one went up was Switzerland. So Switzerland increased up to 39. I don't know what Trump made this big deal about Switzerland. What does he have against Switzerland? They just have watches and chocolate and a lot of really, really wealthy people. Like skiing. Like what's he?
Maybe he's upset that they've lost. They've lost the power of being the place, the most secure banks in the world now. Now that they came in, I don't know. I don't know what anybody has a problem with Switzerland. How that affects it. It's not like they produce a ton of stuff, like you said, chocolate. I mean, I don't know.
Maybe he's trying to support Hershey. I don't know.
Yes. There you go.
Yeah, I mean, honestly, like Switzerland is so neutral about everything. They stay out of everything. It's like if you wanted to hide money or hide assets or just hide yourself, like Switzerland's a great way to go because they're never going to get any wars. They're never taking any sides. They're doing all their own stuff. Like they don't bother anybody. Like it's just kind of a funny country. But anyway, I wanted to share these because I think it's interesting. Like a lot of tariffs have dropped. People are still yelling and screaming on the news about tariffs and, it's going to destroy the world. We're going to have inflation. Okay, we might. I haven't seen it. So once again, this goes back to the topic of Trump. Like everyone's like, oh my God, tariffs are the worst thing. All the economics professors and all the economics geeks out there are like, oh, this is great. Like this is going to ruin the world because tariffs are bad and all that stuff. And if you remember what I said in the show, it was, I don't know. I'm an economics. I have an economics degree, and I know what I heard and learned. But Trump is different, and I heard him on Joe Rogan, and he mentioned tariffs, and he didn't get into it. And I was like, "That's an interesting idea. I'd love to hear more." And no one has elaborated on the more. He's never elaborated on the more. So I understand what he's saying. It doesn't necessarily make sense to me. But it doesn't mean it's not going to work, and it doesn't mean that it's not going to be good. I don't know. What I do know is this, is that if you add tariffs, someone's going to pay for it. It's either going to be that country, or it's going to be our consumers, or it's going to be some sort of corporation, right? There's a manufacturer, there's the company that sells it, and then there's the buyer. Like there's a handful of people in the mix. So who's going to pay for it? It's not going to be the country, right? They're not going to pay for it. It's going to be some sort of company or the consumer. And so if you think about it, all right, well, that means someone's going to pay. Well, people naturally think it's going to be the consumer. Yeah, but corporations have a large, fat profit margin right now. It used to be back in 2008, from 2000, 2008, where corporations, what they would do is they would, in tough times, is they would squeeze their profits. And when they couldn't squeeze them anymore, then they start laying people off. Now, since 2008, what I feel, and I don't have the large data, but what I feel is profit margins in general have increased, and when we go into bad times, they're not shrinking. They're just they just find ways to not hire people back, which is weird. 2008 was like, oh, they didn't hire a lot of people back. That's weird. So they just kept their fat profit margins, and so they have room to eat it. And some companies have. Some companies said, no, we'll eat that. Okay, do you have that much? Because 15, 20%, it's kind of a lot. We're like, yeah, we'll eat that. Now, that might be temporary. It might be, supporting the Trump, like Trump probably went in and said, all right, you're going to do this. It's like what he did with Tim Cook. Like, all right, you're going to produce them all in the U.S. And Tim's like, all right, we're going to do that. And then, like, he produces one, there could be a lot of stuff that's PR. So I don't want to hold a candle to it too much. But I think that it's possible for these companies to eat it for a little while, but at some point it's going to expand prices. Now, the question is, if it causes prices to rise, which prices have risen a lot in the last 5 years, not due to tariffs, by the way, but if prices continue to rise, as long as wages rise along with it, it's okay, right? So if you think about like two lines, right? They're two lines kind of going sideways here, and you have wages and then you have prices. Prices go up and wages go up. It doesn't matter because you've got a spread. You're making more money, you can afford to pay for it, right? The problem is if prices rise and wages don't, which is what's been happening for the last 15 years, that's where the problem is, because it means you can afford less. But if wages rise, then it really doesn't matter, because you have more money to pay for it, and it all kind of works itself out. So I think that's really the important point that doesn't hit the headlines, is that it's not just prices, it's prices and wages. Now, unfortunately, people are not making a whole lot more, but that is an important context to have if you're talking about prices. It's also wages. So just want to bring that up. That's a good visual here for those of you. Go ahead, Doug.
Oh yeah, no, it's I think a couple of things. Well, first of all, I mean, the thing that's different, we've talked about this too. The thing that's different about Trump in this regard is that we've got a situation where a lot of this is just it's negotiating power. So we don't the thing that it's like we're slapping them on, but they're changing because and the issue is we don't really know, and I think companies don't know what the outcome's going to be, because a lot of this is ways to try to get them to move, to try to do them something different, and then if they follow through on that, then we pull back. So the impact of just slapping tariffs hasn't really overly affected anything yet, because for the most part, a lot of those tariffs got delayed by 90 days, 45 days, whatever it was. And in a way to say, look, what I can do. I'm giving you a chance to rectify. There has been stories of companies that have announced that they're going to do more development here. We've actually seen that for example, one of the industries that's been very has a limited effect from the tariffs has been the auto industry. I mean, Toyota looks at it and goes, because companies like Honda and Toyota have been building their cars here forever, and they're already looking at building more plants here in the first place. So it's like, okay, yeah, we're talking about slapping on Japan, but that auto industry is already a major employer of U.S. Matter of fact, you could argue that they actually are more invested in supporting the U.S. auto worker than the U.S. domestic auto companies are, which moved a lot of operations to Mexico. Ford came out and said there's no way that that these tariffs are going to absolutely disrupt them. There's no way they can shift it back. But I mean, like I said, talked about Columbus, Ohio before. Marysville, Ohio, right outside of Columbus, Honda plant. It's one of the biggest Honda producers. As a matter of fact, I think I looked at this a while back, but almost like 50 to 60% of all the cars that Honda makes, if not more, are already made here in the United States. So guess what? They're looking at this like not a big deal. You talked about the tariff revenue effect and the swallow of it and the profits. I think it's a good kind of good touch on this. We just saw the numbers come back, that there is basically we're seeing massive profits coming through. We just had our quarterly reported revenue, consensus revenues. Almost every company is coming back reporting profits. One of the best quarters for profits that we've had in a long, long time. So they're still able to successfully extract a lot of, they're keeping their bottom lines down. They're, this is one of the arguments that, the people have. It's like, wait a second, you're telling me the prices are going up because costs are going up, but then you have more profits. I don't see where the connection is here. And obviously when it comes to the tariff side of things, Goldman Sachs just came out with a very early analysis of tariff effects through June 2025. Granted, there's been some movement. It's now June, it's now August, and some of those tariffs, of course, got delayed. But there has been so far an unwillingness to pass these tariffs on directly to the consumer. The consumers only ate about 22% of the tariffs in their analysis. Foreign exporters absorbed 14% of U.S. tariffs. The U.S. companies themselves ate about 64%. So even protected U.S. companies raised prices. So everybody took advantage of raising prices to some degree. And the consumers will see bigger price increases. They're estimating about 70% through the fall. So as of now, we haven't really felt a lot of the impact of that. Now, one of the arguments against the tariffs is that, of course, the company, the foreign companies, they don't actually get impacted by this. The data seems to show that right now, when you take a look at only 14% of foreign exporters absorbing the cost. So you're seeing U.S. companies who obviously have doing manufacturing in other countries absorbing a lot of that so far. I've talked to companies that are in the manufacturing space, both domestic companies here, in the United States, as well as foreign companies operating in the United States. There seems to be a mixed bag of feedback that I'm getting from them, Kirk, where, I said, it looks like, they've absorbed them. It sounds like there's going to be passing more. Several of them have said to me that, they believe that the those that have passed will pass, and those that won't pass. They don't see, and this was actually coming from a foreign company that does, engineering, industrial engineering. They said, we've passed, we've already passed. We don't see passing anymore. Again, I think that's really hard to say, and I'm not hard to get consensus on, especially when we've had these delays in this tariff policy. So I'm not sure all of them have completely and fully felt it yet, but there does seem to be some rhetoric coming out from those companies saying, I don't think we don't even see that there's going to be that much more impact. But that goes counter to what Goldman Sachs is currently estimating.
Yeah. So let's also talk about some other news, which is interest rates. And, what's interesting is you hear a lot of talk about interest rates, because Trump's basically beating up on Powell over interest rates. They need to be lower. They need to be lower. I heard a good podcast this weekend. They were talking about rates and what it would cost, and what if Trump had his way and interest rates were down to 1%. It's interesting. I mean, if you think about where it is now, 4.25, 4.5. They didn't drop rates, to nobody's surprise, by the way. Like, no one expected they were going to drop rates. In September, there's an 82, almost 83% chance they're going to drop rates 25 basis points. What I find interesting is, if you look, and this is the Fed Watch tool, so this is kind of like the probabilities of the Fed dropping rates at certain intervals. When Powell's job comes up for renewal, which I think to nobody's surprise will not get renewed. I even think he said he doesn't want to get it renewed. I'm not 100% sure, but I believe.
Why would he want to at this point? It's just been a constant onslaught against him.
Yeah, I mean, he's just the whipping boy, and frankly, if I was him, I wouldn't do it either, because it's just going to be, that bad Fed Chair Powell, and that's how your legacy is remembered, because it's the president who's knocking on you.
And he'll make so much money consulting as ex-Fed chair. I mean, come on now.
Yeah, they make plenty of money, and I'm sure there's some side benefits too. But here's the thing: if you think about this, Like, what are lower rates going to do? Lower rates are going to cause the markets to rise. They're going to cause, well, hypothetically, they're going to cause markets to rise. They're going to cause people to borrow more. They're going to cause the dollar to be cheaper, and maybe even cause a bubble. It's going to when I say hypothetically, it's going to do all these things. Now, I also know that hypothetically, rising interest rates should cause real estate prices to drop. It should cause the markets to drop. But yet, we haven't really seen that. So the real question, because back 50 years ago, 40 years ago, maybe even 30 years ago, interest rates actually impacted the markets. But in the last 15, well, actually in the last, 18 years, 17 years, I don't know if they've really impacted the markets. I have to say that. And I know it's weird, because we all think that we live in an economics classroom and that if this happens, this happens. It should. But to me, and I follow this stuff pretty closely on sentiment, it feels to me like none of this stuff really matters. You'd think it would, but I'm not sure if it does. Because if it did, the Fed raised interest rates from virtually zero up to 5%, I think it was 5.25%, something like that, or whatever the range was. They raised it a whole 5%. Okay. The markets went down. 30-year treasuries went down 55%. The stock market went down I think it was 30%. It was a bad year, right? And then rates were pretty much the same. And all of a sudden the markets went back up. It was like it never happened. And the rates didn't drop. We're still at 4.25%, and the markets are at all-time highs, and interest rates are fine. And real estate keeps going higher. So my point is what you think logically is going to happen doesn't necessarily happen. It used to happen. I'm wondering why it's not happening. It could be because they should have been higher much earlier, but they kept doing QE because the Fed was so sensitive about the market bumping around. Oh my God, we had a hiccup. Let's spend more money. To me, that's just BS. I thought the economy was fine, but they were very sensitive for years. So now it makes me wonder, is the market broken? It's an honest question, right? Is the market broken? And I don't mean broken in a bad way. I mean, the mechanisms of cause and effect no longer work. I've been hypothesizing this for the last at least 10 years, is that the market is broken. It does not operate in a logical way anymore. I mean, think about it. Trump caused tariffs to go off the charts. People lost their minds. Markets went down 20%. And then they came back. And then we lowered tariffs. Markets didn't really budge. So what's going on? I mean, I understand the logic is when effectively things happen, the market is priced in well in advance. I get that. And for people who don't know, if there's news that Trump's going to do something in 3 months, the market prices in what they think he's going to do before it happens. It's the surprises that catch the market off guard. April was a surprise. People were not expecting, China's 200% tariffs, or I forget, it was 150% or something crazy. But they weren't expecting that. They weren't expecting everyone to have off the chart tariffs. They weren't expecting those things. So that's why the market dropped. But then the market came back because the market stopped caring. So my point is, I wonder if going forward, if all this news really matters, does it actually impact the market, or is something else impacting the market that is much, much more powerful than all these things that people seemingly think matter? And I'm going to make 2 quick points. I'll hand it back to Doug. One is, we talked about this last week, the CPI. Government numbers don't matter. They don't matter because people, I honestly don't know if people really, if the professionals really take it into account. I mean, they do, but Does it really matter? I don't think so. Does it matter if the CPI is 2 or 2.2? No, because the numbers are made up anyway, in my mind. So I don't think people are even, GDP, CPI, all those numbers. I think they're all bullshit. I mean, honestly, I've tracked them for a long time. I stopped tracking them because I think they're bullshit. I do. Because they don't make sense. Things that should make sense don't. I'm just like, you know what? This is garbage. I'm not going to pay attention because it's not making the calculus change at all. So the point being is, all right, so if government numbers don't matter, why bother? Don't bother with them. What about interest rates? Well, to some degree they do, but they really don't. If all those things don't matter, what does matter? Earnings? Nope. Earnings don't matter. No one seems to care about earnings anymore. What happened in April? All the companies dumped their bad news in the tariffs. Oh my God, it's going to kill our earnings. And all the analysts they dropped the earnings estimates. Oh my God, it's going to be bad. We're going to drop everything. What happened this month? 63% of companies to this point beat earnings. Huh. Well, if you drop the bar low enough, it's really easy to stumble over it and beat the earnings. And that's basically what's happened. Oh, and by the way, that's not new. That's been happening for over 20 years, where companies, they say, oh, God, it's going to be bad. And then they're like, oh, well, let's drop the earnings. And then, oh, look, it's easy to beat. Look, we beat earnings. Yeah, that's happened for a long time. That's an old game. Everyone knows about it. Point being is, yes, a lot of companies have beat earnings, but I don't really care because it's all a big facade. It's a big game. What matters is the company growing, and is in an individual level, does it matter? Yes. On a large macro level, absolutely not. But you should know that earnings estimates are BS. So what should matter is, what is the company doing, and that should not be on a quarter by quarter basis, but more like on an annual or every other year basis of like, how's the company doing? How are the metrics growing? That's more important. That's more of a fundamental perspective. And frankly, even that doesn't matter. And if it did, value investing would be doing well, but it's underperformed for 20 years because people don't give two shits about fundamentals anymore. It's not that they don't matter. They matter a whole lot less than they used to, which goes back to my thesis, the market's broken. So all these things. So what does matter? Well, there's only one thing that I can find that actually matters for the most part, and that is liquidity. How much money is being put into the system, whether through QE or money printing or COVID money or whatever it is the money supply expanding? Are they printing more money, or is it shrinking? Now, they've flattened the money supply for a while. I don't know where it is today, but pretty much 9 months or 12 months prior, it was pretty flat. Where they weren't making more money, and they were keeping it contained because they were waiting for the economy to catch up for all the excess that they had before, and it didn't seem to matter to the stock market much. So the stock market still went up last year, even in spite of that, which I didn't think it would. So that's been the biggest marker I've seen to say, is the market going to go up or down? Is the liquidity expanding or contracting? But we have so much liquidity, they could contract it a little bit and it wouldn't matter. So I still think that is the most important factor of anything else, because that seems to be the highest correlation of markets going up, markets going down, but it's not 100%. So just something to keep in mind, that no matter what you look at, all the headlines in the news, oh my God, this is happening, Trump's ruining the world, and oh my God, this is going to go to zero. Ignore it all. Look at liquidity as the most important factor. People talk about the dollar. Oh my God, the dollar's going up, the dollar's going down. Does that matter? I don't know. People say it matters, but honestly, I track it and compare it to gold. It is not. It is a very loose correlation. Very, very loose correlation. I think people pull it out and they're like, oh my God, the dollar's going down, gold's going up. In that circumstance, it happened. But I would say 50% of the time, at least, it doesn't. The dollar goes down, gold just stays. So I don't think the correlation is where people think it is. It used to work that way. There used to be correlations, used to be causations. Now everything's kind of loose, and it's hard to really base your decisions based on one other factor that has a extremely loose correlation / causation to the thing you're looking at. So I think ultimately you look at liquidity and you look at price. Is price going up? Buy it. Is price going down? Don't buy it. And I hate to be that simplistic, but that's really what it comes down to nowadays. It's really that simple. I hate to say that's the best way to invest, because everything else is, I don't know. No one has any idea. You talk to all the smart people that come up with some theory that ends up not correlating well, and then you're like, well, it's this, and they come up with some other reason. I just don't see it. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money. Go ahead, Doug. I'll hand it off to you for a little bit.
Well, what you just said there at the end, I think, is the biggest thing that's broken there. It's if the price going up, buy it. If the price going down, don't buy it. That right there is fundamentally reverse to the old adage of buy low, sell high. But now it's interesting because there was a period there where momentum really became the hot ticket item for how to track where you should be investing. And when something like that comes out, people will start to follow it to the point where it becomes diluted, right? If everybody's chasing momentum no longer works, because the instant that everybody follows in, it'll reverse. By the time you know about it, it's too late. And the reality of that is that is the case to a degree, right? Because if you're trying to find things that are reversing quickly with momentum, but the reality is momentum's not reversing anymore. I mean, look at what the S&P 500 has done since 2008, and it's not that we haven't had those pullback years. We still have hit some of those pullback years within the 5 to 7 normal ranges that we normally would. It just hasn't been the extravagant pullback, the recessive type of pullback, the absolute reset to the markets. It's a dip. And then it's almost like as soon as that dip hits, it concentrates the octane and bam, it takes right back off. So we're seeing this, we're not seeing the same level of dips, but we're seeing, and sometimes we're still getting that intra year a little bit like March, April this year, but it's where it's pulling out from there and how much it's going up after that is just absolutely blowing away, historic averages. And so, I think you're right. You've just got to follow the trends. But I want to go back to an analogy here and I posted a couple things on this. There's a couple of people, one of them, Brian Westbury, is an economist, has talked a little bit about exactly what let's talk quite a bit about what you're talking about, that the Fed funds rate, which is effectively where where the Federal Reserve gets involved, is not working like it used to. And I'm going to start with an analogy. Where kind of look at this as a broken thermostat. So if you think of the economy like a big house, and the Fed is the one controlling the thermostat, right? For decades it worked. If you turn the dial up, the house warms. You turn it down, it cools. Perfect. Now imagine if half the windows are open. People are running in and out. Someone hooked the house up to the neighbor's heating system overseas. The Fed can still twist the dial all they want, but the temperature inside doesn't change like it used to. What's happening, this is kind of what's happening with interest rates. In the old days, raising rates, and it has, I think, a lot more to do with the influence that we have. When we talk about the waning influence that, the United States has, there's some direct correlation there. In the old days, raising rates slowed the economy. We controlled so much of it. It cooled inflation. Today, global money flows, complex financial tools, and supply-driven inflation means that the Fed's dial isn't connected to the heater like it was before. You could still the Fed still has power. They can still crank it so cold, so high that they freeze the pipes. They could hit us into a recession. But they can't fine-tune that comfort the way they used to. It's not, the thermostat's not necessarily broken. It's just running a heating system that's no longer in their basement. And so when we take a look at it in a little more detail, and I've got a few charts I threw up there if you want to show them, those rising rates, when they slowed borrowing historically, they cooled the economy, they lowered inflation. And when they cut rates, you got the opposite. But now what's happened is capital markets are outflanking the Fed. The money can move across borders. It can tap into offshore lending. It can use complex hedging to bypass rates entirely. If you look at real rates, that's, the Fed's rate minus inflation from 2008 to 2020. Real rates were near zero, even negative. But did we see runaway inflation, Kirk?
Nope.
Not at all. Fast forward today, the real rates are as high as they were before the 2008 crash, even though inflation pressures are mostly supply driven. Energy shocks, supply chain issues, geopolitics. That's the stuff that the Fed cannot fix with rate hikes. So the bottom line here is that the Fed can still cause a recession, but that fine tuning, like they could in the 80s and 90s, this is where things have changed. This is where it's broken. The markets now lead and the Fed follows. And unfortunately, and this is what what was the talk a couple years ago, Kirk? Is the Fed too late? Right? Is this transient? Inflation. What the Fed was basically now the Fed is reacting and it's often too late. They're not the forerunner to this. So when we start hearing now the Fed has raised rates to fight inflation, yeah, we have to understand the old playbook does not seem to be working like it used to, that the game looks like it has changed. And the Fed is now, unfortunately, instead of being the player, it's not a tennis match anymore where they're one player controlling the outcome. It is now more like soccer, baseball. They're one player on a major field. So going back to some data here, one of his charts that I put up there that you're showing, we can see a decoupling of rates from inflation from 2008 to 2016, ultra low rates but minimal inflation. 2021 to 22, surging inflation, despite the fact that we've had rapid rate hikes. And yeah, did they have an effect on the markets? They did. 2023 was not a fun year. But it was very short-lived. It was more reactionary as opposed to a cause and effect relationship. The inflation today, as I said before, it's supply-driven and it's not necessarily demand-driven. So this tightening can crush borrowing, but that doesn't make you make ships unload faster or oil wells pump more. So that's just kind of, and you talked about it. Markets have already priced this out. So the last thing, kind of on this is that it's trailing these market-driven yields like the 2-year Treasury. When the Fed finally catches up, the damage is often done either by overstimulating bubbles like late 90s, mid 2000, or tightening in a slowdown like 2006, 2007. The gap between market rates and Fed policy suggests that the bond traders often set financial conditions before the Fed can make its move.
Yeah, I find it really, really fascinating. You see all these charts. We won't keep going through them because I know Doug has a topic he wants to talk about. But yeah, it's the more seasoned I become, the more I distrust pretty much every piece of data that's coming out, and things don't align in the way they used to. There was a time where people that used to be able to be a macro strategist and kind of go through and look at all the numbers and you could make bets. Now it just seems like people are just guessing. People are getting lazy. Things don't correlate. They're not causative in the way they might used to have been. And there was a time where those things that the Fed did mattered, and now they don't. In part because the way that things are connected, they're just not connected. The system's broken. And so it just means you have to use a different set of tools in order to know how to operate. So Doug, I know you want to talk a little bit about private equity. So have at it. We got 10 minutes left here, or let you have the horn.
Yeah. So I thought it was an interesting article that it didn't necessarily come out the other day, but it was kind of reposted the other day. And it was about a company that probably most people now know as a household name. Many of you will either make your breakfast, lunch, or dinner using their product, and that's the Instapot. The Instapot was the rage especially during COVID when people were working more at home. And this article came out, talked about how they went bankrupt. They actually declared bankruptcy by mid 2023. So I don't know if any people know that the company is in extreme financial duress, which is really, really interesting considering that it was as popular as it was. And it really, I wanted to talk about it because from a standpoint of what how popular it was. It's a combination of two things. It's a combination of both sometimes the failures that come from being made too well or too popular, but also some of the an example of kind of what has happened or what we're seeing in a world where private equity has found a very profitable playbook at the demise, unfortunately, of many of the brands and that we're used to. And I'll come give you some examples as we come back to that. But first of all, one of the things that really kind of started with Instapot is everybody got it. People discovered the pressure cooker. It's funny because I kind of laughed when it came out. I was like, really? This is something my mom used to make a dish, beef and noodles. Still one of my favorite dishes she ever made, using pork shoulder, bone-in pork shoulder. You can't even get it anymore, which tells you something about the meat industry and just the mass production of it anymore versus the cuts we used to get. But she used to use a pressure cooker to make it tender. It was amazing. And then all of a sudden it's, pressure cookers kind of fell out of favor because, some of the early ones, they blew up. That doesn't go over well with the public. And then Instapot comes out and makes this magical thing that's a pressure cooker. And so everybody fell in love with it. Part of the issue was it was made too well. They actually did a great job, durable, high performing. And it was not something people felt they needed to replace. So this became a one and done purchase. A very similar example of that was the Nordic Track. Nordic Track was what was a hot commodity for working out 20, 30 years ago. And again, huge rise in sales. And then ultimately they had an issue with the fact that they couldn't repeat that. So they had one product that was excellent, explosive rise, but then sales fell sharply. People had them and they couldn't really come up with something else. By early 23, sales were down roughly 50% from 2020. So it was a ceiling, right? But then what happened, and this is the segue, is that private equity got involved. So 2019, before they blew up, and again, the private equity started out being a great way to build up the brand because, of course, it injects a ton of capital. We talk about inflation, a ton of capital into the company to build it up and to get it expand. So they bought Instant Brands. And what they did is they merged it with Corel, which is the same, company entity that has Pyrex. Most people know that. And so it created these high growth expectations. Durable goods aren't designed to meet that. And it misaligned that pressure. What happened is then they tried to expand into other things. They couldn't. But the biggest issue, and this is where private equity has found a very profitable playbook, is over leveraging it. And we're talking really over leveraged. Over $500 million in assets and liabilities. An unsustainable debt load that created an inevitable Chapter 11 bankruptcy by 2023. So obviously it was a great product. It's still a beloved kitchen staple. It was a product. The failure was really the strategy behind it, and it was growth for growth's sake, especially under heavy debt. Now, what are they doing? Let's talk a little bit more about the private equity and really that debt side of it. So they acquire the brand for $615 million. They discover shortly thereafter that they've overpaid by much as $273 million, owing to inflated 2018 financials. They renegotiate it. They lower the price, settle on a $268 million misrepresentation claim for just $55 million. Founders get off easy. Damage is done. Then what the private equity companies do is they do something called dividend recapitalization. This is something that's very controversial and plundering from the inside out. So in 2021, red flags unspoken, they loaded the company with $450 million in debt. It's a term loan stacked with internal cash. That money then starts to fund a dividend back. It's interesting. Money comes in to produce a dividend. I don't know what that looks like too. There's some other things out there, Kirk, that have been built by money coming in, funding the money coming out. But I guess if it's private, it doesn't matter. But anyway, we won't go there. that funded a $345 million dividend that went straight back to Cornell Capital, its co-investors, its company founders, and its managers. Heck, the firm ended up walking away with $200 million. The trustee overseeing bankruptcy claims, actually, argued that Cornell and execs lied to lenders, admitted major issues. But ultimately, the inevitable aftermath was drowning over in $500 million in liabilities and 7 straight quarters of plunging sales. All of a sudden, bankruptcy became a logical outcome. The playbook here, overpriced buyout, and we see this time and time again, extract value fast via debt-fueled dividends, conceal truths, and ride away, leaving the company in ruin. Okay, so there's some other examples of this. So we know about Instapod, but ultimately some other companies that when people look around and say, where are these companies? What happened to these companies that I know of? Very similar story with Sears. It was actually a very profitable company until basically all of its assets got extracted out of it. Jo-Ann Fabrics, Jo-Ann, it's whatever they renamed their company to be, they just went under. A beloved brand that anybody who in the industry of sewing and fashion and crafts love this place, and it was extremely profitable until all of a sudden they got taken over by private equity, and again saddled with a tremendous amount of debt. We actually saw this with Red Lobster. Red Lobster got taken over by the company that actually does shrimp, all these wonderful shrimp promotions. They were actually extracting all the money, forcing them to buy their shrimp at inflated costs. It saddled the company with debt. They're starting to work their way back out of it. But unfortunately, it left that company in tremendous financial distress. Toys R Us, it was a childhood icon. Now it's a warehouse. They borrowed, they were almost predatory the way they drove all the other toy stores out of business. Toy Story, good movie, out of business. But what they did is once they got private equity in them, they borrowed boatloads via dividend recaps, chased quick returns, $2.3 billion in debt, jumped to $6.6 billion. Once again, e-commerce surged, too leveraged to pivot, ripped that childhood memory. Simmons Bedding is another example. Neiman Marcus, another example. We talked about Sears, but there's also Kmart, Linens, and things. The reality is that as a business model, I can't argue with it. Private equity has done an incredible job for those that invested in private equity. Private equity has, their mandate is to provide to their clients, and they've done that. Their ability to provide those dividends back to their clients, their ability to provide growth on that initial investment has been fantastic. Unfortunately, that playbook has an inevitable ending, which is to take the brands that many of us are aware and love, and it strips them into a figment of our past imagination. So we could talk more about this again as we're coming up on the hour here, Kirk, but it is something that I know that people are interested because we're seeing more about this in the news. And it is definitely a polarizing business strategy.
Yeah, we'll come back to this another time. This is private equity. I will say this one point, and I want Doug to wrap it up because we're at time. Is that if you saw the news about private equity wanting to get into 401k plans, I think that is a horrendous idea, horrible idea.
Yep.
Private equity is, in some ways, they're not the vultures. They're the thing that caused you to die. There are kind of vulture capitalists. The problem with private equity is, yes, they make a lot of money. It is the smartest people in the room typically work in private equity. It works in many ways, and in some ways it doesn't. Right now, private equity is lacking additional capital, and this is part of the reason that they're trying to get into 401k plans because they're running out of capital. Not only are people not investing, but they can't find deals, but their deals aren't doing so hot either. In general, they're overvalued. It's kind of tough to be in private equity. I would not invest in private equity right now. 5 years ago, I talked
again. Their business model relies on capital coming in to extract dividends out. Sounds like something else to me. But let's.
So I talked to a lady 5 years ago, and I asked her, she worked in private equity. I was like, "Oh, so you invest in your own stuff?" She started laughing. She's like, "Hell no." She's like, "Everything's way overpriced." She's like, "I wouldn't touch our stuff." And she ran it a good shop. So it wasn't, it wasn't her product. It was the fact that everything overall was overpriced. Anyway, Doug, take us home here in this short time.
Absolutely. And I'll say this, you touched on something, private equity and 401ks. We didn't touch on this today, but we should come back to this. They actually are talking about now allowing crypto in 401ks. So this is, I think, a big news headline that hit this week we can talk about later. But thanks. My name's Douglas Hagren. For those of you who are, first timers, those who've listened for a while, have seen me, met me. Many of you, founder of Mergent Advisors, Mergent College Advisors. Before we go, I did want to say another thing that hit the news was over the last month or so is the big, beautiful bill that got signed in law in 2025. It has dramatically reshaped federal student loan policy. I had a chart today that we can come back to another meeting that just, again, we've talked about before, the incredible rise of college tuition costs. And unfortunately, this is something that has created a massive debt load to families who are trying to absorb these costs, get their children to these great schools, but unfortunately they're still paying on it. Their kids are still paying on it, their graduate loans, etc. And the federal government is trying to tamp that down because the federal loan system is really the primary lender for this education. And ultimately what they see is this untapped money that they've been willing to give through these loans has allowed these institutions to just raise price whatever they want. But now they're going to put borrowing caps in. And they're real. Graduate students limited to $20,500 per year. That's $100,000 total. Professional degrees to $50,000 a year, $200,000 lifetime total. Do the math there. It doesn't add up fully. The lifetime federal loan access is now capped at $257,500 for all families. Okay. Plus loans gone entirely. Out-of-pocket costs for many elite programs just went up. High-income families are now going to shoulder more of it directly. Now, you've also got income payment plan options like Save, Pay, and ICR being eliminated. You've got public loan forgiveness going away. We've got forgiveness timelines to RAP, the Repayment Assistance Plan, has extended forgiveness timelines to 30 years, larger monthly payments as income grows. Ultimately, the goal is to push tuition costs down because the schools, you talk about private equity, if there's not enough capital for people to be able to pay for schools, then they're going to have to lower their costs in theory to be able to make it to where it's affordable to get families in. That even if that works, it is not going to be immediate. And that means far less upside and far more risk, even for borrowers who thought they were covered. College planning isn't just an elective anymore. For affluent households who pay more, who qualify for less aid, who often handle six-figure tuition bills, this legislative shift is a strategic minefield. So Emergent, we do comprehensive planning, all wealth planning, retirement planning, but we've realized that for affluent families, the lack of a college funding strategy, and there's a ton of data out there on this, has been one of the biggest derailment for affluent families that they didn't see coming. So we help families position assets, optimize tax location, model distribution strategies, create private reserve frameworks so that the funding of elite education doesn't blow up the rest of your plan. So if you've built any worth protecting, which I would think most of you feel you have, and you want to fund education without sacrificing retirement or legacy, visit us at our financial services site, mergentadvisors.com, and our college-focused site, mergentcollegeadvisors.com. And that is spelled MERGENT, Mergent Advisors and Mergent College Advisors. Because smart money doesn't guess, it plans, and it's now going to require more sophistication than ever.
Great. Well, thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.